VIP John AG here. February is historically one of the most dangerous months for silver, and what I'm about to show you is that the trap they've set this time around is textbook. I'm talking about a month where silver has averaged negative returns over the last decade, where margin hikes have conveniently appeared right before key contract expirations, and where the paper market has been weaponized to shake out every weak hand holding physical positions. Right now, silver is trading around $32.40 on the COMEX, and gold just pushed past $2,800 an ounce for the first time in history. Let me say that again. Gold just broke $2,800, and yet silver is struggling to hold above 32. That divergence alone should tell you something is deeply wrong with the pricing mechanism in the silver market. The gold-to-silver ratio is sitting near 87-1, which is historically extreme and completely disconnected from geological reality, industrial demand, and physical supply fundamentals. And I'm about to walk you through exactly why February is engineered to be a kill zone, what levels you need to watch, and what the data is actually telling us beneath the surface noise. Let's get into the data, because this is where the story gets very uncomfortable for the people running this game. COMEX registered silver inventory has been in a slow bleed for years. We're sitting at roughly 140 million ounces in registered, down from peaks of nearly 400 million ounces. That's a 65% drawdown. Meanwhile, eligible silver, which is the category that dealers and institutions park metal they don't necessarily intend to deliver, has also been declining. Total COMEX silver inventory is hovering around 290 million ounces, give or take, depending on the daily fluctuations. Now here's where it gets interesting. February is a delivery month for silver futures on the COMEX. That means contracts that were opened months ago come due, and holders must either roll forward, close out, or stand for delivery. And every single time we approach a delivery month, the same pattern plays out. Price gets hammered right before first notice day, open interest gets flushed, and margin requirements conveniently get adjusted to increase the cost of holding those contracts. This is not speculation. This is documented data. Go pull up any February delivery month over the last 5 to 10 years and overlay it with price action. You'll see the same compression, the same shakeout, the same convenient timing. Now let me give you the broader macro context, because this February trap doesn't exist in a vacuum. The Federal Reserve just held rates steady at 4.25% to 4.5%. Jerome Powell made it very clear in the latest press conference that rate cuts are not imminent. The market had been pricing in multiple cuts for the first half of the year, and that narrative got crushed. When rate cut expectations get pushed back, the dollar strengthens temporarily, and that creates downward pressure on metals priced in dollars. The dollar index, the DXY, has been trading around 108, which is elevated compared to last year's range. A strong dollar environment gives the paper shorts exactly the cover they need to lean on prices. And mainstream financial media, the CNBCs and Bloombergs of the world, run the same tired narrative. They tell you gold and silver go down when rates stay high. They tell you the dollar is strong, so metals must be weak. But they conveniently leave out the fact that central banks around the world bought over 1,000 tons of gold last year. They leave out the fact that China's central bank has been adding gold reserves for 15 consecutive months. They leave out the fact that the People's Bank of China and other BRICS-aligned central banks are actively de-dollarizing their reserves and accumulating hard assets. Gold just broke $2,800 precisely because sovereign buyers don't care about the Fed funds rate. They care about preserving purchasing power in a world where the U.S. national debt just crossed $36 trillion and the annual deficit is running above $1.8 trillion. Let me say that again. $36 trillion in debt, $1.8 trillion annual deficit. And they want you to believe the dollar is strong. The dollar isn't strong. It's just the tallest midget in the room. Now, let's talk about Shanghai, because this is where the physical market tells a completely different story than the paper market. The Shanghai Gold Exchange has been trading silver at a premium to COMEX for months. At various points, that premium has been anywhere from 2 to 5% above the London and New York benchmarks. That premium exists because physical demand in China is outstripping the supply available at current paper prices. When Shanghai pays more than New York for the same ounce of silver, it tells you the physical market is tight regardless of what the futures screen says. And it's not just China. India imported record amounts of silver last year, over 5,000 tons by some estimates, driven by industrial demand for solar panels and electronics, plus traditional investment and jewelry demand. India's silver imports have been so aggressive that they've periodically disrupted global supply chains and caused delivery delays at refineries. This is not a market that is bearish on silver. This is a market where physical buyers are aggressively accumulating while the paper market tries to convince you the price should be going down. Connect the dots. On the geopolitical front, the world has not gotten more stable since the last time we talked. Conflicts in the Middle East continue to simmer. The situation between Russia and Ukraine is far from resolved, and defense spending globally is accelerating. Every Tomahawk missile uses silver. Every satellite system uses silver. Every advanced electronics package in modern weapons platforms requires silver. The defense industrial complex is a massive and growing consumer of silver, and that demand is only going to increase as geopolitical tensions escalate. Meanwhile, the BRICS alliance continues to expand. New members have been added, and discussions about a BRICS trade settlement mechanism that bypasses the dollar are ongoing. Whether or not a formal BRICS currency emerges in the near term is debatable, but the direction of travel is clear. The world is diversifying away from dollar dependence, and hard assets like gold and silver are the beneficiaries of that structural shift. Looking at the numbers, about 75% of you watching right now aren't subscribed. If this kind of unfiltered analysis is cutting through the noise and giving you clarity that you're not getting from mainstream sources, hit subscribe. That's how we grow a community built on truth, not hype. Drop VIP John AG in the comments so I can see you. If this isn't for you, no hard feelings. I don't chase empty metrics. I don't sell signals. I don't sell mentorships. I don't sell courses. I show up, I break down the data, and I let you make your own decisions. That's it. Now here's the smoking gun. Here's the part they don't want you to see. Let me walk you through the February playbook because once you see it, you can never unsee it. Historically, February has been one of the weakest months for silver prices. If you pull up seasonal data going back 20 years, February averages a negative return. Not every single year, but the pattern is statistically significant, and the reason is not organic selling pressure. The reason is structural. February is a delivery month, which means the COMEX needs to manage the flow of physical metal. If too many contract holders stand for delivery, the exchange faces a problem because there isn't enough registered silver to satisfy all outstanding contracts simultaneously. The solution is elegant in its cruelty. You raise margin requirements in the weeks leading into the delivery window, which forces smaller speculators and leveraged longs to liquidate their positions. You use the futures market to push price down, which triggers stop losses and creates a cascade of selling. And you use the mainstream media narrative of strong dollar and no rate cuts to provide intellectual cover for the takedown. This isn't a conspiracy theory. This is market mechanics. The CME Group has the authority to raise initial and maintenance margin requirements at any time, and they have done so repeatedly at precisely the moments when it would inflict maximum damage on long positions. Go look at the margin hike history. Look at when they raised margins on silver in prior years. Overlay it with the calendar of delivery months. The correlation is not subtle, it's blatant. And here's what makes this truly insane. While the paper market is engineering lower prices, the physical market is screaming the opposite message. Reports from major dealers in the United States show that premiums on physical silver products, especially American Silver Eagles, remain elevated. The U.S. Mint has struggled with production and allocation issues for years now. Silver Eagles that used to carry a $2 to $3 premium over spot are still commanding $5 to $8 over spot in many cases. 100-ounce bars, which are the closest physical product to the wholesale market, carry lower premiums but still reflect tightness in supply. Try ordering 1,000 ounces of physical silver right now and see what your delivery timeline looks like. In many cases, you're looking at weeks, not days. If the market were truly oversupplied and bearish, as the paper price suggests, you would see premiums collapsing, inventory piling up at dealers, and immediate delivery on any order size. That is not what's happening. What's happening is the exact opposite. Premiums are sticky, inventory is thin, and delivery times are extended. The paper market says silver should be cheaper. The physical market says you can't get enough of it. One of those markets is lying, and I'll let you figure out which one. The Shanghai Futures Exchange silver contract has been consistently pricing above COMEX, and the premium has widened during periods of paper market weakness. This tells you that Asian buyers, who are arguably the most sophisticated physical market participants in the world, view every paper-driven dip as a buying opportunity. They are not panicking, they are accumulating. The People's Bank of China, commercial banks in China, and private investors across Asia are buying physical metal at a pace that is historically unprecedented, and they're doing it while Western financial media tells you silver is going nowhere. If you've been watching this channel, you already knew this divergence was coming. I've been talking about the Shanghai premium for months. I've been talking about the disconnect between paper and physical for even longer. And every time the paper market engineers a shakeout, the physical market responds by buying more. Now let me address the bearish case head-on, because balance matters and I'm not here to be a cheerleader. The bearish case for silver in February is real, and it deserves your attention. First, if the Fed maintains its hawkish posture and rate cut expectations continue to get pushed further into the future, the dollar could strengthen further, and that creates headwinds for metals. Second, margin hikes could accelerate. If the CME decides to raise silver margins again, leveraged longs will get wrecked, and the price could break below key support levels. The critical technical level to watch is around $30. If silver loses 30 on a closing basis, you could see a flush down toward 28 or even 26. That's not fear-mongering. That's technical analysis. The 50-day moving average and the 200-day moving average are both key dynamic support levels, and a break below both on volume would be technically significant. Third, if there's a broader risk-off event in equities, silver tends to get sold along with everything else in the initial liquidation phase. Silver has a dual identity as both a precious metal and an industrial metal. And in a deflationary scare or a liquidity crunch, the industrial side of the equation can drag price down temporarily. Bitcoin is currently trading around $97,000, and if crypto and equities sell off hard, silver could get caught in the crossfire. Fourth, China's economic recovery has been uneven. If Chinese industrial demand slows, it removes one of the key demand pillars for silver. The bearish case is not impossible. It's not even improbable in the short term. And if you're using leverage or trading on margin, you need to be aware that February is specifically designed to punish that behavior. This is why I always say protect your capital first. But here's the thing. The bullish case hasn't changed one bit, and if anything, it's gotten stronger. Let me walk you through it. First, the supply deficit in silver is not going away. The Silver Institute has documented a structural supply deficit for 3 consecutive years. Mine supply has been essentially flat for a decade, while industrial demand has surged. Solar panel installations alone consumed over 160 million ounces of silver last year, and that number is growing at double-digit rates annually. Electric vehicles use roughly twice as much silver as internal combustion engines in their electrical systems. Artificial intelligence infrastructure, specifically the data centers and server farms being built at an incredible pace, requires silver in circuit boards, connectors, and thermal management systems. 5th-generation wireless networks require silver. Defense systems require silver. Medical devices require silver. The industrial demand story for silver is the strongest it has ever been in history, and mine supply cannot keep up. Second, J.P. Morgan built a massive physical silver position over the last decade. Various analysts and researchers have estimated that position at anywhere from 500 million to over 1 billion ounces. They didn't accumulate that kind of position to lose money. They accumulated it because they know exactly where this market is going long term. They can afford to be patient. They can afford to let the paper games play out because they hold the physical. Third, central banks continue to accumulate gold at record pace, and historically, gold leads and silver follows. Gold just broke $2,800. When gold makes new all-time highs, silver eventually catches up, and when it does, it moves violently. The gold-to-silver ratio at 87:1 is a coiled spring. A reversion to even the historical average of 60:1 would put silver above $46 at current gold prices. A reversion to the geological ratio of roughly 15:1, which is the actual occurrence ratio of silver to gold in the Earth's crust, would put silver at numbers I don't even want to say on camera because it sounds too extreme. But the math is the math. Fourth, the monetary debasement story is accelerating. 36 trillion in US debt, global debt exceeding $315 trillion, central banks printing, government spending, and fiat currencies losing purchasing power at an accelerating rate. Silver has been money for 5,000 years. Paper currencies have an average lifespan of about 40 years. Every single fiat currency in history has eventually gone to zero. Silver never has. As I said in the previous video, the question isn't whether silver will be repriced higher. The question is whether you'll be positioned when it happens. 3 key takeaways and we're out. 1. February is historically engineered to be a trap for silver longs. Margin hikes, delivery month mechanics, and coordinated paper selling create a window of maximum pain for leveraged positions. If you're holding physical, this doesn't affect you. If you're trading paper, be extremely careful this month. Know your levels. 32 is near-term support. 30 is the line in the sand. Below 30, you could see a deeper flush, and you need to be prepared for that possibility. 2. The divergence between paper and physical has never been wider in practical terms. Gold at 2,800, silver struggling at 32, dealer premiums elevated, Shanghai trading at a premium, central banks accumulating, industrial demand at all-time highs, and supply in structural deficit. The paper price is a fiction that serves the interests of the institutions that control the futures market. The physical market is telling you the truth. Decide which market you trust. 3. The macro backdrop is the most bullish it has ever been for hard assets. 36 trillion in debt, geopolitical instability accelerating, de-dollarization gaining momentum, and the BRICS nations actively building alternatives to the Western financial system. This isn't a short-term trade. This is a generational shift in the global monetary order. Silver is not just an investment. It's insurance against a system that is mathematically guaranteed to fail. The unresolved tension is this. If gold just broke all-time highs above 2,800, and the gold-to-silver ratio is sitting at levels that have historically preceded explosive silver rallies, and the physical market is tight while the paper market is suppressed, how long can this divergence hold before it snaps? And when it snaps, which side of the trade do you want to be on? That's the question you need to sit with. That's the question that should keep you focused, not fearful. Do your own due diligence. Understand the risks. Be accountable for your own decisions. Nothing I say here is financial advice. I'm sharing my analysis, my data, and my perspective. What you do with it is entirely your responsibility. Protect your capital, stay sharp, and don't let the noise distract you from the signal. Invest with logic, not hype. VIP out.